overview. Today we've got Sam Miller and Matt Kim joining us from Signature Investment Advisors. I want to thank everybody for being here, those that brave the heat to be here in person in this room, as well as all those that are joining us remotely. Matt, I'll hand it over to you to introduce Sam today.
Wonderful, thank you so much.
Thank you.
So again, my name is Matt Kim. I'm one of the senior relationship managers with SIA, or Signature Investment Advisory. We're a firm based out in Los Angeles, managing roughly $6.5 billion in assets, predominantly families like yourselves. And we're glad to be here and join you guys. With me, I have Sam Miller, who is our Director of Investment Research. And he's going to go into a little bit of a market update here and hopefully provide a little bit of time at the end of it for any Q&A. So we hope you guys enjoy. And here's Sam.
Thanks, Matt, and thanks everyone for joining us today. So Matt and I are in the privileged position of working with Corey and team and other advisors and clients around the country, and so we get to hear all sorts of good questions that come into our inbox or people call us up. And so what I'm going to do today is kind of walk through what are the questions that we've been hearing the last, call it 3 to 4 months or so. What kind of questions are we hearing from clients? So I'll bounce around a little bit, but while I'm bouncing around, I'll also kind of weave in our investment outlook and our investment overview while I do that. So I created these slides a couple weeks ago. I think, as everyone knows, the world's moving pretty fast. Things are changing all the time. I didn't get a chance to update the slides based on the last 5 days of information, but I'll kind of talk through that. So one of the questions that actually came in late last week, it was a client who was concerned about what's going on in the Middle East. I'm worried that the US is going to take action against Iran. I want to go to cash with my portfolio. Please take action to do that next week for me. So in the meantime, we start putting together a response like, we think you should stick with your portfolio. And we went back and actually looked at every military incursion that we have had in the last 100 years, from Pearl Harbor, Vietnam, Korean War, the Gulf War, Afghanistan. How did the market perform 12 months later? And in pretty much every instance, the market was significantly higher 12 months later. Now that runs a little bit counterintuitive. You think about the world, bombs flying and bad things happening around the world. It shouldn't be a positive thing for markets, but it's actually been a little counterintuitive. The lone instance out of the last 100 years where we had a military incursion and we're down 12 months later was Afghanistan. And when was Afghanistan? That was 2001, 2002. There was something else going on around that time. The dot-com bubble was, call it popping or deflating, however you want to phrase it. So there was other things going on at that point in time, and the markets weren't necessarily being driven by what's going on across the world with a war. So that's one thing to keep in mind. The other thing we looked at was, energy prices. Everyone has to fill their gas tank up at the pump if you've got an old-fashioned car. So what about oil prices? Now, we had the US bomb the nuclear facilities in Iran over the weekend, and just as everyone predicted, volatility went lower on Monday and Tuesday. Energy prices dropped by 10%, and the markets are near all-time highs. It's the exact opposite of what you'd think. You'd think volatility would go up, energy prices would start spiking. I do think that energy prices are probably, depending on what happens, go a little bit higher from here. And there are a couple different factors at play. So Iran produces about 4% of global oil supply. So if they take that offline, that's going to restrict supply. They're also adjacent to the Strait of Hormuz. So if they decide to disrupt the flow of oil, generally speaking, that's going to send prices higher. But there are other factors that are going to influence things. One of which is OPEC, in the last several months, has made the decision to allow for greater oil production around the world. So that's going to increase supply, and at the same time, the U.S. is producing more oil than ever before. So those are the things that are balancing each other out at this point. But I wouldn't be surprised if from here we see oil go slightly higher over the next couple months. So that's the geopolitics aspect of today. And let me just start to jump into some of these other questions that we're getting. So a question that we were getting last month is, there was a headline, maybe you remember it, maybe you don't. Moody's, which is one of the 3 rating agencies, downgraded US debt from the highest level to the second highest level, AAA to AA. So what does that mean? Is that a bad thing for us, a good thing for us? And The answer is it's not always as straight and clear, cut and dry. So typically, when a corporation's debt gets downgraded from AA to single A or single A to triple B, the market responds pretty immediately. It costs more for that company to raise money. They pay higher interest rates. And as you can see from the chart here, it's not always the case with U.S. debt. We were downgraded by S&P back in 2011, and interest rates actually went lower from there. We were downgraded by Fitch back in 2023. And since the downgrade recently, interest rates on the 10-year Treasury are about 4.3 now, so they've come down. So no immediate implications from the downgrade, but I think it speaks to kind of a longer term issue that we have of our debt and our deficits and things that need to get addressed in the long term. So far, the markets aren't calling us out on it. We aren't paying higher interest rates on our treasuries yet, but we'll see what happens. So the implications are, if we do end up having to pay more to fund our debt and our deficits, that'll flow down to interest rates that we pay, credit cards, auto loans, mortgages, the rates that businesses pay to take on loans. So those are the implications over the long term, but in the immediate term, nothing quite yet. All right, so next question. What's the latest on the one big, beautiful bill? I think you're probably hearing about this in the headlines. And what we're witnessing right now is, how laws get made in our country, kind of the messy stuff that goes on in Washington. I think if we talk a month from now, I wouldn't be surprised if this legislation is enacted, whether it's late July, early August. It seems like we're on a track for something getting done in the next 4 to 6 weeks. And this really relates to the last slide as well, because it's going to cause our debt to go up. But it seems like the thought process is that we're going to be able to grow our way out of debt. Now, we're not the first country to say that or try this experiment, but that seems to be the approach that the government's taking. We're going to try to stimulate both the consumer and businesses in a couple of ways and try to grow our way out of our debt problem. So we'll see what happens. But in terms of parts of the legislation that impact consumers, a couple of the key provisions: no tax on tips, no tax on overtime, being able to deduct your interest on your auto loans, child tax credit expansion, things like that. And then the SALT tax deduction's another key piece that's being hotly debated. So we'll see how it all plays out. But again, I expect to see something in the next month or so. That's on the consumer side. On the business side, there's a bunch of key provisions, one of which is reinvigorating what are called opportunity zones. So this is something that came out of the 2017 Tax Cut and Jobs Act, where the governor of every state was able to designate certain areas, typically low-income areas, as opportunity zones. And they created certain incentives for investing in those areas. And it seems like that's going to be a part of this new legislation as well. So we're keeping an eye on that. Another one is call it accelerated depreciation for companies. So if you're a business that invests in heavy machinery, plant and equipment, you typically have a long time horizon to depreciate those on your income statement. What's being batted around now is an accelerated timeline for depreciation. So any business that's got a lot of expenses like that, whether it's utility, data center, and airline or railroad, is going to benefit from that because they're going to have, basically call it a tax shield in the short term, which is going to increase their profitability. So if you're looking at certain companies that'll benefit from that, I'd expect them to see higher prices in the near term. Beyond that, I think we're going to see some more deregulation for financial services companies. I know Capital One is locally here, so if we have people that work there, Capital One might benefit from deregulation alongside other financial services businesses. So those are some of the key provisions to keep an eye out for, as well as market impact. Next question. This is one that I wouldn't imagine we would have gotten 5 years ago, asking about private credit, but it's become more and more popular and more mainstream lately with the way portfolios are constructed. So let me just take a step back. So we invest portfolios for our clients, and they typically consist of some stocks, some bonds. It kind of depends on how much risk people want to take. But on the bond side of the portfolio, bonds are usually there for a couple reasons. One, to provide diversification, to provide income, to have stability. And usually we're using liquid instruments like treasury bonds, corporate bonds, mortgage-backed securities. But in the last 10 years, we've seen this kind of a niche space called private credit creep into portfolios more and more. So private credit came out, it's been around for a long time, but post Great Financial Crisis, you think about some of the banks that caused the crisis, a lot of regulations were put on them. And because of that, they really stepped away from lending to medium-sized businesses in our country. So in stepped certain asset managers, and really took the place of legacy banks to do private lending. Fast forward to today, 15 years later, it's a $1.5 trillion asset class, and we're seeing new sorts of funds pop up here and there, and we're seeing a lot of interest in it. But the question is it about to be tested? I think anytime you see that amount of inflows into an asset class, it raises questions. And then also we talked about interest rates. So interest rates are staying high, which if you're an investor, you get paid more, which is a good thing. But the other side of the coin is if you're running a business and you have to take on loans and those interest rates are staying higher for longer, maybe your business is going to have a lower likelihood of paying that debt back. So I think those are some of the concerns, along with it being a new asset class. At the end of the day, we view private credit as a complement to traditional fixed income portfolios. And we think manager selection is critical, being able to underwrite loans. So we partner with only the highest quality managers out there. So that's just something to keep in mind with private credit. Question on tariffs. So I think the diagram here that we're trying to depict is that the markets oftentimes move faster than the real economy. So what we saw in April was markets took a nosedive. And why did they take a nosedive? Because we weren't really sure what the point of tariffs were. There was the thought the markets had was that, are we using tariffs to try to balance the budget and have some fiscal austerity? And that was why the markets freaked out in April. And they bounced back as soon as President Trump announced the 90-day pause. But what we're going to see in the next couple of months and quarters here is how does this play out in the real economy? Oftentimes the real economy trails the way the market reacts in the short run. So we know tariffs aren't there to balance the budget, but why are they there? I think there's a couple different hypotheses that President Trump has alluded to. One, they're a negotiating tool. Two, they're a source of government income. And three, they're an instrument to reshape the U.S. economy. So let's kind of talk about all three of those ideas and to what extent they may or may not have merit. So the first one, as a negotiating tool, let's look at exports as a percentage of GDP. This might be a little bit hard to see, but the U.S. Exports are 11% of GDP, whereas our major trading partners are much higher. Germany's at 43, Mexico 36, Canada 33. So from that angle, yes, we could consider tariffs as a source of leverage when we're negotiating these different deals. We're not as reliant. The next angle is to what extent these sorts of countries do business with us. So Mexico and Canada, over 3/4 of their trade is with the US. They're very reliant on us, whereas for China and Germany, it's closer to 10 or 15%. So to the extent they're an export-driven economy and they do a lot of business with us, yes, I think we can exert some influence from a negotiating perspective. So that all makes sense. I think the next one is, tariffs are a source of revenue for the government. Now, if you look on the right side here, again, it might be tough to see. The big blue bar is total receipts for the Treasury, $5.2 trillion over the last 12 months. This tiny, tiny little blue blip is the amount that we took in from tariffs. Historically speaking, tariffs have been a rounding error. It's less than 1%. So they have not been a meaningful source of revenue historically, but for the month of May, we brought in $22 billion in tariff revenue. And if you annualize that comes out to about 5%. So it goes from less than 1% to 5% is not a rounding error. It's not a ton, but it's starting to become meaningful. So the 90-day pause is going to end on July 9th. I think between now and then, maybe a deal gets done. It's really hard to imagine which country we're going to do that with, whether it's Japan or India. It's highly unlikely that we're going to get a deal done. So my estimate is that number of $22 billion a month is going to go higher from here. And tariffs do start to become a meaningful source of revenue when you look at it that way. So there is some merit to that concept. And then to the last one of, are tariffs going to reshape our entire economy? There's this idea of onshoring manufacturing, and I saw some memes about people putting together iPhones in a factory, and this is the one that's tougher and tougher to imagine. So what this chart depicts is, go back 100 years, our economy was primarily a manufacturing economy. 30% of jobs in 1939 were manufacturing jobs. And today it's less than 10%, 8% manufacturing jobs as of today. So it's really tough to imagine transforming and going back to something north of 10% or 20% or even 30% in manufacturing jobs. Another thing to consider here is the salaries of workers who do those manufacturing jobs around the world. US has some of the highest paid manufacturing workers on the left side here, along with Germany. If we were to level the playing field between us and everyone else that we import from, you would have to levy massive tariffs on India, Mexico, Vietnam, Malaysia to try to level that. It is just really hard to imagine being able to levy that level of tariffs and really level the playing field from a manufacturing perspective. This is the kind of thing that's going to have to play out over quarters and years, and it's really, of the three hypotheses, this is one is the toughest to imagine. So, but we'll see what plays out from here. I think in April, things weren't necessarily as bad as they seemed in markets. When you're looking at your portfolio, and as of today, things probably aren't as good as they seem. We're probably going to have a little more bumpy road from here as we navigate these deals, as the market tries to digest the winners and losers of tariffs. And then I guess another point on the way the market moves relative to the economy. What you see on the left here are the returns of trucking stocks in the first couple months of the year. So January trucking stocks were up slightly, February down 8%, March down 10%, April down another 12%. Trucking stocks were getting absolutely hammered even before April. But on the other side, you look at inbound container ships in the Port of Long Beach, up 45%, up massive amounts throughout the first quarter of the year and into April. So this is one where the market moves way faster than the real economy, but we'll see how this plays out in the coming months and quarters here. From a portfolio perspective, the way that we're managing money is we're tilting towards more service-oriented businesses that aren't as interest rate sensitive, that aren't as tariff sensitive relative to goods-oriented businesses. We also favor bigger companies relative to smaller companies, so you'll see that in the portfolio as well. We just feel like bigger companies are better able to navigate tariff issues. They're better able to navigate a brand new tax legislation. They've got hundreds of accountants and lawyers on their legal teams. So we're tilting the portfolio in that way. Next question. Will there be a recession? Answer is yes. I can't tell you when though. So I don't think it's going to happen this year, but at some point in the future, we will get a recession. The way I would characterize our economy as of today is late cycle. And you can see that on the left chart here with GDP is still positive, but it's getting lower and lower, and it's staying positive. But the thing to keep in mind is about half of our economy is consumer spending on services, which are relatively inflation resistant, and that's growing at almost 7% a year. So the service economy is strong. But if you were to ask me if we're going to get a recession, there's really two high-level things that I look at. One is the state of the consumer and jobless claims, which you can see on the right here. The long-term average is 2.8 million continuing claims. Today, we're about 1 million below that, and it's not really showing any significant spikes. So looking really good from an employment perspective on a longer term basis. And then the other piece is investment grade spreads. So credit, is credit available? Can you get a loan as a business or as a consumer? And for that, we look at the spread between treasuries, what the interest rate is on a treasury versus what the interest rate is on a corporate bond. Over the long term, that's been about 1.5%. And as of today, it's 1%. So that tells me the credit markets are healthy. You can get a loan if you're a business or a consumer. But that's another area that we're watching. And the next question, when will the Fed start cutting rates soon, and how will markets react? So Fed Chair Powell just did a press conference yesterday. He seems like he is in no hurry to take action from a cutting perspective. The markets are pricing in 2 cuts this year. Maybe we'll get 1 or 2. I think at this point he is being very patient. As I mentioned earlier, the consumer seems healthy, unemployment is low, and that gives him cover to be more patient. He wants to see what happens with tariffs and how that eventually flows through into the real economy, like I was mentioning earlier. So what we know is that either companies are going to pay for tariffs, or they're going to pass on those costs to consumers in the form of higher prices, which are inflationary. So he is going to be patient, and I think he's going to kind of stick with where we are in the 4.25% to 4.5% range. A little bit longer here. We'll see what happens. And then lastly, how should investors position in the current environment? So the first thing to mention is, we're pleased with how the portfolios are working because diversification's working. So this is a chart of returns of stocks outside the U.S. versus stocks inside the U.S. And for stocks outside the U.S., they're up north of 16% year to date. From when I created this chart, U.S.-based stocks are flat to slightly positive. So diversification is doing its job within U.S. versus international markets. And then similarly on the bond side, the orange line here is the Bloomberg Global Aggregate Bond Index. Provided a ton of stability in April when markets were going crazy, up about 5.5% year to date. So it's not like 2022 where both stocks and bonds were down at the exact same time. Diversification is working this year, so we're happy about that as investors. So again, tough to read for the folks in the room, but I wanted to just kind of pull open the hood and give a sense of how we approach making investment decisions within our portfolio. So we built a proprietary framework, and what this does is looks at various indicators. The top section is a group of indicators that indicate an overheating economy. So if inflation is accelerating, gas prices are higher, things like that. That's telling us the economy's overheating. The middle section is what we call Goldilocks, not too hot, not too cold. You've got positive growth, but maybe it's slower growth, but not stalling out completely. And then the bottom section are indicators that would tell us, hey, we're either in a recession or we're heading towards a recession. You've got deflation, earnings slowing down, investment grade spreads widening, things like that. So as of today, we're about 62% in this middle bucket, which really is a way of summarizing that it's a good investing environment right now. And that's something we watch on a weekly basis to see how those numbers are bouncing around. So long story short, it's a good investment environment from our scenario analysis. Another thing we have is a proprietary, it's called a growth index indicator. And what we do is there's different quartiles. Today we're in the second quartile, which is the 50 to 75% range. And this is the best area to be from a forward returns perspective. When we've been in that third quartile, the average 6-month return for the S&P is 12.93%. So just another data point in telling us that we're in a pretty good investing environment right now relative to these other quartiles. So from a positioning standpoint, for what we're doing in our portfolios, we're overweight U.S. versus international, just slightly. Within U.S., again, like I mentioned earlier, we're favoring more service-oriented businesses, companies that aren't going to get hit too hard by tariffs. So those are the more growthy areas. We favor large stocks over small cap stocks at this point. Again, thinking about who's going to be able to navigate tariffs, going to be able to navigate tax changes. But within international, we do like emerging markets. We think with what's going on with debt and deficits, The dollar's already weakened by about 10% year to date, and we think that has more room to run. And then on the fixed income side, we favor core fixed income relative to high yield. We just don't think you're getting paid as much to take that risk as of today. And then within certain sectors of the U.S. economy, I should have explained this, but on the right side, the plus indicates that we're overweight. The minuses indicate that we're underweight. So for sectors, we're overweight communication. That's one we added to recently. If you look at the valuation from a price to equity standpoint, communication services have a lower PE ratio, and they've got some really high quality tariff resistant companies. Think Google, Meta, Netflix, things like that. Same idea with technology. We're overweight financial services. I mentioned deregulation earlier. We think financials are going to benefit from deregulation. And then utilities have been, they're a boring sector historically, kind of like a bond-like sector, but more and more recently, they're a good way to benefit from the artificial intelligence trade. So those are some of the sectors we like. And again, this is reflected in our portfolios. So long story short, we think if this is a representative of an economic cycle, we're getting later stage. We're watching the labor markets closely. We're watching their credit markets closely. If we start to see weakness there in the portfolios, you'll start to see us add more to things like staples and utilities and healthcare, more defensive sectors. We don't feel like we're there quite yet, but that's what we're watching. I'll pause there and see what questions are out there, and if not, I'll hand it back over to Corey.
Any questions before we wrap up?
I have 3 from online, actually.
All right.
All right, 3 online questions.
So Sam, when I say these to you, if you don't mind just saying them back.
Yeah.
So that way people online can actually see it and everything. But the first one is in regards to tariffs, right? So obviously you talked about the pause talking, I think it was July 9th, right? And we saw what happened earlier in the year, right? That kind of drastic drop on that Liberation Day. So is it reasonable, kind of with everything that you talked about there, that if those tariffs go back in place, that we would see a similar effect? Or is it kind of priced in at this point? I mean, what's your kind of thoughts there?
So if I can summarize the question, basically, are we going to have a similar experience as April when the 90-day pause ends on July 9th? Does that paraphrase it adequately? I don't think it's going to be this. I'm not expecting us to get another 20% drop. I think the administration was not great at communicating when these first came out, what the actual ultimate goal was. And you can see here, we're trying to digest it ourselves. What's the actual purpose here? And I think the clear response when he put the pause in place was that this is not a tool to try to balance the budget. And this combined with the tax bill, I think is further evidence of that. There's not really we're not taking a fiscal austerity approach to balancing the budget. So because of that, I don't think the markets will be as shocked, depending on what happens here, but it will be a messy process. These things, even 90 days is not long enough to negotiate deals with every country out there. So it's going to take a long time. And I suspect there'll be more side deals and things that get excluded along the way. But it could be a messy, volatile process for investors. I don't expect it to be as messy as April, but it could be. Exactly.
Okay, so the second one I have is you talk about the consumer and the strength and everything, but on the other hand, you see headlines all the time about credit cards kind of being all-time highs, right? Obviously, the concern with that is those consumers continuing to service that debt, right? So do you see that as a sign of consumer weakness, or is it just kind of a headline that comes across right now?
Yeah, so the question is around, we see headlines on credit card debt being at all-time highs and delinquencies and things like that. I think that is a cause of concern for certain consumers. One of the things that we look at is the checking account balances across the economy, and checking account balances are still extremely strong. COVID was 5 years ago, and we had all this stimulus money that went in, and it's still sitting in a lot of checking accounts. So while it's true that certain people are having more and more trouble paying their credit card balances, from a big picture perspective, there's still a lot of cash on the sidelines. That does give us a little bit of comfort, but it is the credit card delinquency issue is something that we're monitoring as well.
Okay, perfect. And then the last one that came through, you showed that chart between international versus U.S. stocks. Do you consider that to be a short-term type of phenomenon, or do you think that has kind of legs? Because for the longest time, right, I mean, for probably most people that are in this room, right, it hasn't been that case. So is this something, like you said, you're still overweight U.S., right? So is there an expectation to change that, or do you think that it will just, again, kind of be like a year for 2025, for example?
So the question is on US versus international stocks. Do we expect international to continue outperforming from here? So I think there's a couple different things to think about. So we're global investors, so we're always going to have some US and some international in our portfolios. As of today, we're still tilted towards US relative to international stocks. But I think, you know, there's a couple different angles from international stocks that makes them attractive. One, it's the valuation. So if you can get an energy company based in England for a price to expense ratio of 10 versus one based in the US for a price to expense ratio of 18, for very similar companies, you're potentially buying more of the business at a lower price. So from that perspective, international can be attractive from a valuation perspective. Beyond that, there is a tailwind of the dollar. So I mentioned the dollar already has depreciated about 10% this year. If we're going to keep adding to deficits, adding to the debt, there's a reasonable expectation that the dollar could keep weakening from here, which is another tailwind for international stocks. So it's tough to say if it's going to have legs from here, but we think there are those two tailwinds that could help out at least this year. So.
Very good. Well, Sam, I think everybody in this room and everybody remote leaves with a clear perspective on some of these challenges and opportunities. So thank you for being here. For those of you at home and in the room, if you have questions about how this outlook could affect your strategy or portfolio, please don't hesitate to reach out to us. And one last time, I want to thank everybody for braving the heat and being here in person, as well as everybody that's joining us remote. Thank you for the opportunity to serve you, and we look forward to seeing you soon.